7:15 or 7:16, so we'll get started here this morning. Headline news. I mean, this is one of the things that we talk about that, not fundamental news, but a new addition into our market that can dictate prices and what we see coming on. So we had the conflict in Iran that's beginning. Overnight calls on Sunday night were much higher, which we did trade higher right at the beginning, and then closed down in most of the grains. The crude oil side and the gas side traded much higher, so the initial expectation is not a big effect on the ag side, but the crude gas oil side could have bigger impacts if this is a longer lasting conflict. So the timeline of events, this has been an ongoing ordeal since last April. It's escalated multiple times. The market has kind of brushed it off as we have moved along. One of the big things that we've talked about with conflicts between, the Russia, Ukraine, that had a big effect on the availability of grains to the world market, the flow of grains. That's why we saw the drastic rally that was there. Previous issues in Israel and other issues in Iran earlier this year and last year didn't have a big impact on the market since it didn't affect the grain flows to the world. So, we'll have to watch this as we move forward. The biggest thing, to watch is going to be the amount of oil that moves out of this area. Typically, the price moves in oil will have an effect on ag prices. As we can see, a 4% move in crude does have an effect on the ag markets. Not as big of moves, but they are followers of the overall crude market, whether it's commodities in general or just the effect that it can have on break-even costs. And as we move forward here through this today, we'll kind of see one of the biggest impacts. Just crude oil charts we're touching. We're up again this morning. These were charts from last night, but we are nearing the highs from earlier this year. The question will be is, can we break through $80? Some people are wondering if this conflict is extended. Does that price range, move closer to $100 a barrel? So we'll have to monitor this and see how extended and what actual impact the Strait of Hormuz has on oil prices moving forward. The volume, you can see it here. There is a lot of barrels of oil that move through the Strait of Hormuz. So if this is extended, it could have an impact on, overall crude prices and petroleum products. And the petroleum product side, as we start getting into fertilizer, especially urea, this could be one of the bigger impacts as we're moving into planting season, and watch the effect that has on fertilizer prices. Yesterday, paper trades in different markets, DAP considerably higher, urea considerably higher. So the market is going to price this in up front here and then see what effect and how long this lasts. But if this is an extended conflict, we could see this start to trickle down into our break-even numbers. Does that give the market a reason to start to question trendline yield for corn, especially? That could be the one thing that we've been missing to give the corn market a rally is, how are we going to have a lower yield out there? And this could be one way. Do we not use as much fertilizer if prices are drastically higher? Or, does this brush off over the course of, a couple weeks and no change to fertilizer flows long term? So it's something to watch. We are slightly higher in ags this morning. That might be reflecting some concern on this higher fertilizer market. Another big headline news, Trump's tariffs. The Supreme Court ruled on it. They moving forward, we can't. I guess his tariffs are got struck down by the Supreme Court. And as we start looking at the revenue that was coming in from these tariffs, what will happen moving forward, and will this money have to get reimbursed? Quite a few questions, but it also changes some of the strategies that he had in place for different grains. Will China now, without having tariff restrictions being put against them, actually come in and buy U.S. beans? Some of this balance, it sounds like the meeting between Trump and Xi was might be postponed or even canceled. So, at the end of the day, a lot of things are unknown moving forward. The demand side through the tariffs is questioned. And then we now have the opposite side with the Iran conflict moving forward. The funds last week were big buyers of basically everything, but especially wheat. We saw soft wheat rally hard. The funds were buyers of nearly 50,000 contracts. And then another big day of buying in Kansas City that actually got them long hard wheat for the first time in quite a few years. And when we go back and look, this is the first time since 2023 that the funds are long hard wheat, and they're nearing their lowest short position in soft wheat since early 2023. So the funds have definitely come in and moved this market. The question will be going forward is, fundamentally, if the crops are there and the balance sheets are as big as they were, will they maintain this position, or will they push back to some of their short positions that they've previously had on? There are some structural changes in soft wheat. We've had the VSR trigger kicked into baseline storage for soft wheat. So the attractiveness of staying short through big carry markets in soft wheat might not be there. That's part of this fund short covering. And the question will be is, do they reestablish the short, or do they maintain this position? And that'll be part of the longer term price moves as we move forward. But I think if you have good world crops and another big balance sheet, which we'll talk about later, they probably try to reestablish some of this short position. And when we go and look at the overall, this includes Matif and Minneapolis wheat. They have covered a huge amount of their shorts across all the wheat markets. And I wanted to point out a few spots going back into the summer of 2023 and the summer of 2024, and even last spring when we had the rally early. We've seen these rallies where the funds come in and cover. They get a feeling for overall world crop size, and then we make a leg down. So the question will be, is this year similar to the previous 3 years where we had a big rally and then the funds come in and reestablish the short position? If that's the case, then we need to be looking at marketing, this rally that this market's giving us. Now, there's a lot of stuff out there that's not directly wheat related, but the wheat balance sheets as a whole, would probably dictate that we need to reestablish some short position and move lower at some point here moving forward. So, borrowed this chart from Mike O'Day. Headline risk and fund market structure. The two things that are, short term can be extremely bullish. We've gotten both of those here over the course of the last 2 weeks. That's given us a very good rally in wheat. Now it's going to come down to, what is the global supply going to be? We're coming into crops coming out of dormancy. We're going to see kind of initial feelings on what some of these world crops are going to be. And if there aren't major issues in the world, then fundamentals over the longer term are going to come into play. And that's what we're going to need to trade long term as we come here into the spring. So wanted to look, I showed this maybe a month ago, major exporter ending stocks. This is going to include Russia, Ukraine, EU, Australia, Canada, basically all of our major exporters. And wanted to point out, the big price moves when we got sustained rallies or price pops in these markets, 2012 and 13, we were drastically lower in world carryout than where we are today. We're at one of the higher exporter carryouts, when you look back over the last 20 years. So there's no reason to think that there isn't enough wheat in the world to supply the market, even if we do have some small issues in global production. Going through and looking at 2016 to 2018, which was some of the periods that, we traded lower long term, carryouts were extremely comfortable across the world and even lower in global exporters ending stocks than where we sit today. So the world's in a comfortable position. Doesn't really justify any big price moves unless, we have a major crop issue somewhere this spring. And when we look at world wheat conditions, there is some dryness, some concerns around there. But, looking at the U.S. side, we have some dryness, but crops look good so far. We need moisture, but that's something that we can solve here over the next month and a half. And so we have a lot of time, could see some volatility in the meantime, but no major spots of issues across the world. French wheat, kind of started a little bit of the rally. They did have a drop in crop conditions, nothing overly concerning, but it is something to watch in terms of crop conditions as we move forward. And the U.S. side, we do have a drought in especially Oklahoma and Texas. The question will be is, can this area that is in drought get recovered from hopefully some of the rains that are here in the forecast? The longer term monthly outlook is above normal precipitation. So if we can get into a wet spring here, I don't see any major concerns for wheat, at least here in the short run. One thing to point out is the U.S. hard wheat acreage. They showed a big increase in Oklahoma. Don't necessarily agree with that. But at the end of the day, the market is going to end up trading total production, and that comes to harvested acreage. And that's going to be the major question is how much wheat is grazed off, and what is our final harvested percentage. So the chart on the right shows harvested percentage and overall production. If we have a downtick in U.S. hard wheat harvested, it directly affects the total production for bushels. So that question, will be what we kind of trade here going forward, not only what the harvest or planted acreage is, but what we actually think will final harvested percentage will be to get to what I think our production will be. Right now, using a 725 for next year, which is down roughly, 50 million, 60 million bushels from production this year. And we can still land at a very comfortable carryout, somewhere between 400 and 450. But using my balance sheet in the white, a carryout of 425 with exports relatively unchanged, even though we're not competitive in the world today. It's probably a safe number to start on the export side. And a 425 carryout doesn't need a sustained rally. Even if we drop production down to 650 and see, a drop in exports, which typically happens if we have a smaller crop, you still have a carryout above 400 million bushels. So anyway, you kind of play around with the numbers. The U.S. is a residual supplier to the world. So it's going to take a world crop issue to get us to where we have an increase in exports and really draw down that balance sheet to have a sustained fundamental reason for a price rally. Wanted to look at just hard wheat ending stocks versus price. We looked at world ending stocks versus price. Just looking at hard wheat ending stocks, we're not as high as we were in U.S. carryout from that 2015 to 2021 period where we had sustained values kind of in this same trading range we have been, but that was more between $4 and $5.50, where we're more in this 525 to 575 range. But you look at what our carryout was in 22, 23 during part of that Russia-Ukraine conflict. We drew down hard wheat carryout below 250 million bushels, and that helped really support that rally that we saw. So it's going to take a sizable decrease in our hard wheat carryout to have, a sustained fundamental rally, but it doesn't mean we can't take advantage of some of this market that we've seen here over the last 2 weeks. So looking at price outlook here, we're touching some of the higher spots in July 26 and 27 that we've traded over the last 8 or 9 months. Looking at old crop, $5.80 to $6, gets us right back into that price range that we saw kind of near harvest. I think at least short term here, if you have unsold wheat, it's at least a time to market some old crop wheat, take advantage of this 50 and 60 cent rally that we've seen. Going over into July 26, we're once again teetering on that above $6 mark. Right now we're trading $5.95. So having price ideas above $6, I think, is a pretty good starting point, especially if you don't have anything sold, and if $6 is the worst price that we have on our contracts this year, probably not a bad idea to at least have price ideas in mind. And 27 wheat is trading at 641 right now, and that would be some of the higher prices we've seen in multiple years. So talk to your RMAs, give them a call, see if you can put in some market ideas. But I think these are some pretty good markets to at least be looking at having orders in place. And worst case, you sold 650 wheat for July 27. I don't think that's the worst thing out there, especially since we have found a way to trade, closer to $5 in this previous year after touching similar levels last year. Soybean price outlook, the major question mark after the tariffs got struck down, will China buy more U.S. beans? I think, we've seen this rally. It's partially supported on China coming in and buying additional U.S. beans here. If they don't have to come in and buy and we don't see them come to this market, then our carryout is very comfortable, especially, on the old crop side. And will the fertilizer, if that's an extended issue, lead to more soybean acres over corn, lower input costs on the fertilizer side? That'll be another thing to watch going forward. So looking at price targets, May, somewhere right in this range of $11.75 to $12. And new crop, we're inverted July Nove right now. And, if we see more bean acres, then that inverse probably only increases and doesn't really drag the new crop with it until we really see either China come in or not and get a real good feel for what new crop acres will be. Looking at the technical side on the bottom right, the market is getting overbought, so we could see a correction here, especially if we don't see any follow through in bean buying. As we sit today, the U.S. isn't all that competitive, so we're kind of relying on China to come in and support the export side of the market. Going into corn and milo, this is going to be a question of, will trendline yield get hit this fall? What are corn acres going to be? And can fertilizer, is this a short-term conflict? Will world fertilizer prices continue to increase, or is this just a short-term blip and we go back to normal? So it's going to add a little bit more of uncertainty into this market. I still think on the old crop side, we have a very large carryout, 2 billion bushels plus, and I think you take advantage of this rally that's, trading at the upper end of the recent trading range, and look at something between 450 and 475 going into new crop corn. I mean, yes, there is more uncertainty on the fertilizer and questions on acreage, but we have traded $4 the last couple years. And so if we're trading in this 475 to $5 range, it probably is at least worthwhile to have some orders in mind, knowing that if no changes happen to the world fertilizer market, these prices are very good. And we struggled last year. We traded similar 475 to $5 for a period of time, and then we traded sub $4 when we got closer to harvest. So a lot of question marks in the meantime, but I think some pretty good opportunities here to market new crop corn as well. So as always, call one of your RMAs if you have questions on marketing, or if farmers have some questions or you guys have questions, feel free to call any of them. They'll talk through the markets and give you ideas for contract and contract options. So if there's any questions, let me know.
Hey, Biggs, you mentioned U.S. beans competitiveness to China, how we're more expensive than the rest of the world. What is that, just diplomacy type stuff, or what? How do you see that shaping carry out and other exports to other destinations?
I mean, the price spread, so prices to China today are like U.S. Gulf is above $500 a ton. Brazil quality is below $470 a ton. So the only reason China is coming to the U.S. would either be for reserve beans that they plan on storing and carrying. U.S. beans tend to be their preferred product for reserve. But if they're going for straight crush, they should be buying other origin beans. But if they're coming to the U.S., it's purely to keep Trump happy. Otherwise, price wise, they really shouldn't be buying U.S. beans. The other thing is we're probably losing a lot of the other destinations outside of China. I mean, if you're fob to fob a $30 to $40 premium over South America, the market's going to look at that and, convert to South America for their soybean needs.
Thanks, Biggs.
Any other questions out there?
If they increase the ethanol mandate to E15, do you see that decreasing our exports, or do you actually see us grinding more corn to get more ethanol into the system?
I mean, as long as ethanol margins are there, I think you would continue to grind. I mean, ethanol margins have been extremely good here recently. I think at least on the short run here, we're above $1 a bushel on spot margin for corn into ethanol compared to last year at sub 50 cents. So as long as ethanol margin's there, then yeah, they'll continue to grind hard for ethanol. It just all depends on margin.
On that ethanol talk, how much Milo is going into our ethanol blends today, or our ethanol make?
Kyle, do you guys have a feel for like Texas, some of those ethanol plants, on how much Milo is going in there versus previous years?
I would say this last 18 months, it's been, probably 50 or 60% more than was the 3 or 4 years before that. Like Plainview, they're probably 75 to 90% Milo, and then Liberals probably 60 to 70% Milo right now. I think Lyons has a pretty heavy grind on Milo, and Colwich is straight corn, pretty sure so.
Yeah, Harwell and I had lunch with the guy that buys grain for Kansas Ethanol up there at Lyons last week on Thursday, I think. And from his conversation, it sounded like they're sticking to their grind through on their April, May mile that they bought a long time ago. But after that, they were kind of wide open for June, July. And at this point, it didn't look like they'd be continuing on the Milo situation. So they
What's
have
the
a little bit of specific stuff they do for, I think it's Puerto Rico, where they have to have 10 cars a month that go get exported out of Galveston that are supposed to be Milo. But other than that, they're going to go back to pretty heavy corn.
And if the Milo incentive is there, Travis, if there's additional incentives in the bills for use of Milo, you might see that help grind more Milo. But I think as an overall country, I don't think it's, a drastic swing in corn versus Milo. Just regionally, it's probably larger for us.